we're going to talk about something that is so tempting to so many of us and to many of the asset managers that you might utilize, called market timing. And market timing is that ability of trying to move our investments based upon the idea that we think the market is going to go up soon or that it's going to drop soon. So it's any attempt to alter or change the mix of assets based upon a prediction or forecast about the future. Now, the illusion is that money managers are able to use this market timing to predict the ups and downs of the market. Now, for you, as you're thinking about this, you may be thinking to yourself, well, the market seems like it's at an all-time high. Now, we've talked about that a little bit on this weekly show to demonstrate that indeed, even when the market is at a new high, it's not likely 1 year later that the market is going to be lower. And you can go back to some of those other episodes, but what we're going to talk about today is something else that happens in the background. You as an individual may say to yourself, I'm worried about how high the market is and I may want to get out. And I first want to lay a bit of a tenet on you. And that is that the reason we invest in equities is that we want their prices to rise. So if every time the market has risen to a level it's not been at previously, if we begin to fret and worry, what would be the objective of investing at all? We would instantly, with the success of our actual investing, be scared by the success of our investing because now the market is higher than it's ever been before. Here's the thing. We're going to demonstrate today some of the science behind what happens in markets and investing. We've already talked about the asset managers not being able to keep up with their own track record, let alone the indexes to which they voluntarily said they wanted to be compared to. But there's a little bit of a back door on market timing called tactical asset allocation. Tactical asset allocation is when a fund manager doesn't necessarily just say, hey, we're going to go to cash and then we're going to go invest in stocks again. And that does happen. And as individuals, we may do that. I'm going to keep my money on the sidelines for a little while, see what goes on with this market. When in reality, even if you're in your 50s, you and your spouse have another 40-year investment time horizon. Literally, one of the worst things that could happen to you is that you did a good job of getting, quote unquote, out of the market at the right time. You got out of the market right before it fell in 2008. The problem is almost nobody got back into the market in time to actually benefit from having missed the drop. More on that in a minute. The tactical asset allocation is when an asset manager moves or tilts the portfolio and says, I think U.S. markets are going to do better now. So they tilt the portfolio back to U.S. Or they say, I think China is going to, so we're going to buy more Chinese stocks right now because of what China is going to do. So if you've heard this term from your asset manager, tactical asset allocation, this falls right into a more complex version of should I be out of the market? We're just going to shift what part of the market we're in. It sounds much more sophisticated, but it's still somebody trying to predict the future. Now, how well does that work out? Well, if we look back in time at the Standard & Poor's 500 index from 1985 through 2017, it returned 11.35%. Not too bad. And yet, the average individual investor invested in equity-based mutual funds only returned 4.28% when inflation was 2.62. Heck, if you're in a high tax rate, you barely got ahead of inflation while investing from 1985 through 2017. That's over 3 decades of languishing returns, primarily because individual investors move in and out of the market when they shouldn't, also predicated upon these asset managers not having a great track record when compared to the indexes that they're supposed to be compared to, then the mutual fund companies closing down the mutual funds that had poor performance so they no longer have to keep them in their averages. Those things combined, investors making poor decisions, trying to market time, coupled with the asset managers themselves not having a stellar performance history as related to the index when we correct for survivorship bias, and individual investors end up with languishing returns. Well, let's take a different look at this. Now, what we're going to do is we're just going to take January 1998 through December 31st, 2017. And let's say you just put $10,000 in and you just let it grow the entire time. You just kept it invested, didn't do anything. You just put it in the Standard & Poor's 500 index. Your $10,000 would have grown to $40,000. But what if you just missed the best 5 days of performance? Now keep this in mind. This is 5,040 trading days we're discussing. 5,040 total days the U.S. stock market was open. And all you missed because of market timing, getting in and out of the market, is you missed the best 5 days. You went from $40,000 down to a little over $25,000. If you missed the top 10 trading days, you have $20,000 instead of $40,000. And if you missed the top 25 trading days out of 5,040 total trading days, you got basically zero return for this entire window of time, 30 years. And you got zero return. And if you missed the 30 top trading days, 30 days out of 5,040, you had negative returns for 30 years. This is why market timing can't work. What I want you guys to think about is it's not timing the market, it's time in the market that produces returns. Now, most all of you listening are business owners. Think of it this way. What had your business do really well? Because when things were tough and you were struggling, that you abandoned it, you locked the doors, you said, I'm not coming back to work tomorrow. In fact, I'm not going to come back to work until the business performance picks up. Of course not. What did you do? You stayed invested in your own company. In fact, when things were rough is probably when you did the greatest amount of reinvestment into your company. And the same thing is true when you're investing in other people's companies, which is what the U.S. stock market it is, and the international stock market. We're getting a chance to own little pieces of other folks' businesses, diversifying our capital at work so we're not so concentrated in a single stock. So why is it that there's this prevailing message that we can time the market? Well, we know there's a couple of reasons. One is that the asset actively managed mutual fund complex that's out there wants you to constantly be wanting more and therefore perhaps move your money from where it is to where they are. And you've got all these trading platforms that want to convince you that you shouldn't be using an asset management firm of any kind. You can do it yourself. And it's because of that temptation to get people to move their money that people continue to push these narratives. For instance, how boring would it be if that radio show that people call into, or the guy that pushes all the funny buttons on his board that make noise and rolls up his sleeves on MSNBC and yells at the camera? Well, if the right move was build an academically allocated, globally diversified portfolio that's appropriate for the amount of volatility that you want to take, that show would be real short every week. And as a result, they wouldn't get the kind of viewership that they want. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.